for the first, just quick, like I got to get this transaction in on the other one. I've got them in yellow just so I would be able to find them easily. In your notes, I hope you were able to find them easy as well. It looks like we've got a lady purchasing $1,000 worth of compact discs for her restaurant from Karen Care Music Company. She did use her Visa First Bank card. First Bank is going to charge a service fee of 3%, and here's what it would look like. So she's buying stuff on account, sort of, rather it's just on a credit card with a service fee involved. Is it going to cost her $1,000? No. It looks like this. Keep in mind, this is the entry from the Karen Care Music Company selling to this lady who owns this restaurant. So although they sold sales revenue, they sold $1,000 worth of CDs, they don't get to keep all of that money because we take the $1,000 times 3%, shows up as a service charge expense that Visa gets to keep. It's really easy. It's just that I didn't get to go through it with you. It's very, 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 very similar to when I have my little square that I mentioned with my upcycling business. I plug that little square in. The hookup is actually free. And when people come to me, whether it's at my sales here in Morris, at my sales in the Twin Cities, they swipe a card. If I sell $1,000 worth of stuff, I do not see $1,000 in my bank account because the Square chip reader makes money by exactly what's happening here. My cash does not equal my sale because that's where they make their money. And then that shows up as a service charge expense. Any questions on that? Pretty easy. It's just making sure you do your math right. The last one that we didn't get to was this Friday. I think so. We were talking about notes receivable. This is a weird one. Why would we extend out a notes receivable? How do they differ than an AR or accounts receivable? If we want a long-term note, that's usually one way. Yes, there's a little bit more clout. There's a stronger legal binding, as Ira mentioned. There's paperwork, there's interest with it. Another reason is if an AR is potentially becoming bad, we'll say, okay, we'll give you a notes receivable instead. Give you a little bit more time, but we're going to charge you interest. So what happens when one of the notes receivable goes bad? Here's a really weird example, but here's what they do. Assume that Higley on November 1st indicates that it cannot pay at the present time. If Wolder Company, that's us, does expect eventual collection, definitely highlight, circle that. So we're not going to write it off. We're just going to deflate the balloon. If we do expect eventual collection, what entry would it make? At the time that the note has gone bad or dishonored, assuming that no previous interest has accrued. We're actually going to turn it back into an AR. Seems kind of weird. And then we see notes receivable go down. But we've made some revenue on that thing. Keep in mind this was, you remember the numbers from last week, I hope. You remember that number? Maybe, maybe not. If you look back in your notes, it shows it. So when we dishonor a note, but we do expect to get the money at some point, we just flip-flop it. We say, okay, you used to be an AR. Now we're going to put you to a notes receivable. Now this is going bad. We're going to turn you back to an AR in hopes that we can get the money soon. It seems fuzzy. It seems weird. But then we do have some money coming in as far as interest revenue. So two easy examples. It's just that I ran out of time on both days that I was lecturing. Any other questions on that I can answer? In the book, they talk about this on page 445, if you want to just make a note of that. A dishonored or a defaulted note is a note that's not paid in full at maturity. A dishonored note receivable is no longer negotiable. However, the payee still has a claim against the maker of the note for both the note and the interest. Here's the note, here's the interest. Therefore, the note holder usually transfers notes receivable into an accounts receivable. It illustrates exactly what we just did here. If instead on November 1st there had been no hope of collecting it, we'd write it off. Dart it, bad debt expense, and we'd bring notes receivable down. It's just we're being a lot more hopeful here. And you might say, why are we not using the allowance for doubtful accounts? We're just extending out the length of it, hoping that we don't have to go this route. But we aren't going this route. But then they talk about if it is, then you just dart it and it's done. And then what's going to happen a few months later? Knock, 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 I'm here to pay my bill. And then we got to reopen everything again. So page 445 outlines it if you want more information there. So next I want to do a couple of exercises with you. Like I said, we're going to do exercises 10, 11, and 12. Focusing on these notes. Click on the bottom of page 456 for exercise 910. Elburn Supply Company has the following transactions related to notes receivable, so principal times rate times time, during the last 2 months of 2014. Okay, do you think we're going to get paid in 2014? No, but we've had some interest accrue, so we're going to see how this all shakes out. The company does not make entries to accrue interest except at December 31st. So let's see how this shakes out. On November 1st, we loaned $30,000 cash to Manny Lopez for a 12 month 10% note. How are we making money off Manny Lopez? We're giving him 30 grand. What's he going to have to do in return? Pay us our 30 grand plus what? How do we make money? Interest. Taking that 30,000 times 12 months at a 10% interest rate. We're not necessarily worried about all the factors in that yet. We just know that notes receivable went up and cash went down by 30 grand. Two assets here. We have an asset going up, and we have an asset going down. We're giving this, apparently an individual, a $30,000 note. Probably some paperwork that goes with it, so definitely some signing that goes with it. This gentleman has about 10 months, or am I getting that wrong? 12 months. 12 months to pay this $30,000 back plus interest. Pretty easy. On December 11th, we sold goods to Ralph Kramer, Inc. How'd they pay us? Nuts. I see the word note. So we see notes receivable going up again. They didn't pay cash. They didn't even have an AR. They had a notes receivable. But we sold stuff. We sold $6,750 worth of stuff. They have 90 days to pay us. And we contractually are bound with 8% coming back to us at that's a pretty decent interest rate. We've taken a risk. In the previous one, we risked $30,000 cash. In this December 11th, we've sent almost $7,000 worth of stuff out our door, and in both cases, we don't have cash. On December 16th, we received a 4,180-day 9% note in exchange for Joe Fernetti's outstanding AR. So let's think about what this means. Joe Fernetti must be one of our balloons, okay? He's one of our ARs floating around. Apparently he owes us $4 grand. We're not going to dart him. We're not even going to let the air out of his balloon. We're going to say, all right, Joe, we're going to give you some time here, 180 days to be exact. We're going to charge you 9% interest. We're going to turn you into a notes receivable and get rid of your accounts receivable. For the $4,000. What about the 180-day 9% bit? He's got 180 days to pay us. After 180 days, that's what's called the maturity date. And he owes us that. If, at that point, he becomes a dishonored note, we'd flip him back to AR or dart him. I think we're going to want to turn him into an AR. We're going to keep this as liquid as possible. All right, on December 31st, accrued interest revenue on all notes receivable. I'm counting them. I count 1, 2, 3. We have 3, not even AR balloons out there. Like these are blimps, okay? These are big notes receivables, but they come with some money attached to them in the form of interest. Notice the dates. One of them's only been rocking for 2 months. We've got one mid-December, well, 2 mid-December. We've had interest accrue. It's just that we haven't seen any of the money yet because they don't, when are we going to see our interest? When they, hopefully when they pay. What's the fancy word for that? Starts with M. On their maturity date. On the notes maturity dates is when we'll actually receive the money. But we've earned some of our money. So what does this look like? I want you to put this in, and then I'm going to show you how we've gathered that dollar amount. Interest receivable is going up. So what do you mean? We have ARs, we have notes receivables, and we have interest receivables. What's the receivable here? What are we eventually going to get? Interest or money. We're going to make a little bit of money off extending $30,000 and almost $7,000 and $4,000 worth of stuff or money out to people. That's how banks make money. We're not necessarily a bank. And its credit is, of course, interest receivable. Just like when we sell something. I'm sorry, not interest receivable, interest revenue. Just like when we sell something, we're selling a loan, basically. So how did we get that dollar amount? We have 1, 2, 3 notes receivables hanging out there. Do you guys have some room to do some calculations? Does it actually, like, say, do this for the calculation? Can I see it? Yay, okay, good. So on that first note, the Lopez, and if you want to date it November 1, just so you can kind of see the connection, we have a $30,000 10%, and we'll talk about time in a minute. Remember, it's principal times rate times time. Time can be shown three ways. I'm kind of running out of space here, but time can be a number over 360, and that's days. I know that's kind of annoying because we've always been doing 365, but this is the financial world. This is what they use. Divisible, if it's a note that's listed in days, it's divisible by 360. If it's a month, it's of course a number over 12. And if it's a year, it's a number over 1. So principal times rate times time. Principal's the loan amount. Rate is whatever interest rate it's locked in at. Time is one of three options. So on the Lopez note, keep in mind we're doing this on December 31st. Okay. On the Lopez note, it's a $30,000 loan or principal at a 10% interest rate. Why are we using 2 of 12? I thought it was a 12-month note that he got. How many months have gone by since he took it out? 2. All of November, all of December. So we are earning $500 on him in those 2 months. It's a receivable because he has not paid us that $300. We'll get that at its, tell me the name again, it starts with an M. We'll get that at the maturity date. When is he actually going to pay us? If he took the loan out on November 1st, when will we actually get our money back on a 12-month note? The following November 1st. Good. On the second one, the Kramer note, which is December 11th. Principal times rate times a number divided by 360. Where in the world are we getting this number? $20 days. Is the 31st minus the 11th 20 days? It is. I want to talk about, and in your notes, I should have given you a calendar listing of how many days are in each month. Did I do that in your student notes? Okay, I don't know what random year it is. I know how many days are in every month because I learned a little limerick in elementary school, and it has stuck with me ever since. 30 days has September, April, June, and November. All the rest have 31 except for February alone, and then it talks about leap year. How many of you know the knuckle trick? Did you guys learn the knuckle trick? January, February, March. I'm not a knuckle trick lady, but or I have a calendar provided for you, and you can physically count. So however you know how many days are in every month, that matters here. But I want to read to you about what the book says about it. I want you to go to, and I can either read it to you or you can write page 442. When the due date is stated in terms of days, so that's this one. And who cares if it's at the maturity, who cares if it's at the end of the fiscal period and we're figuring out what we're figuring out on interest receivable, this is important. In counting, and this is in bold print, omit the date the note is issued, but include the due date. I'll say that again. In counting, omit the date the note is issued, but not the due date. For example, the maturity date of a 60-day note dated July 17th is September 15th. So in this case, we're not counting the 11th, but we are counting the 31st. 20 days. it retells that all on page 442. Don't include the day the note is issued, but do include the maturity date. Okay. The last one, Fernetti, December 16th. This business, I believe it was a business, had a principal of $4,000 at a 9% interest rate. How did we figure out 15? We did not include the 16th, and then we counted through the 31st. So we did not include the 16th, and we counted through to, this is not the maturity date, but this is the date we're using to figure out how much interest receivable we have coming. So those three notes combined equal the $545 of accrued interest that's piled up. We can see the interest piling up. We can't get at it until they pay at their maturity dates. Do you see in a testing scenario where this will throw you? Your numbers would be off if you're not calculating that correctly. Don't include the date of issue, but include the date you're going up to, whether it's to figure out your interest or to figure out the maturity date. What can I answer there? There's a part B to this problem. Now record the collection of the Lopez note at its maturity in 2015. Is there a little 2015 bit at the bottom? Okay. So is Lopez going to pay us 30 grand? Yes. Plus what else? Interest. We are going to actually make 3 grand off this fella. Cash coming in is going to be $33,000. You're going to see notes. So I wish they would have put notes receivable first. You're going to see notes receivable go down because he doesn't owe us 30 grand anymore. But let's talk about these two little factors here. We see an asset go down. Have we already accounted for 2 months out of his note? Yes, back up in that problem we just did. Right here. We already calculated 2 months worth. We had to keep our books clean. In 2014, we actually said we earned $500 from him, which we did. We had 2 months of the note go by. Okay. To figure out the rest of what is owed, which is still interest revenue, it's just not that it's owed to us. The remaining 10 months happened. So he took his note out on November 1st, back in 2014. November went by, December went by. That's how we got the 2 of 12. Why is it only 10 of 12 in the next year? Because how much was our total note? We've used 2 plus another 10. Oh shoot, that was the highlighter. So this, we get a lot of money, 33 grand. We see a $500 receivable turn into not a receivable. We've already counted that as money earned, okay? And then we see interest revenue go up and then a receivable go down. It's messy when it happens at the switch of a calendar year. It is. But to keep GAAP happy and to follow accounting ethics, you have to include what you earn one year separate from what you earn the next year. Ira. keep in mind, they wouldn't do it every 2 months. Keep in mind this was taken out on November 1st, and then the fiscal year ended. So we had to update and say, what have we earned? Had it been like a 14-month note, actually let's go 15 months. So we've had 2 months go by here, another 12 here. Then we'd have to stop and say, well, this wouldn't have even happened until deeper into even the next fiscal period. We just have to stop and update and say, what kind of money what do we have coming? This is part of the 2014 earnings. We have to keep GAAP happy. Even though the money hasn't come to us, it's a receivable that we'll eventually get. And here is that we eventually got it. Let's do 11. Exercise 11. Record the following transactions in the General Journal. May 1st, we received a $9,000 12-month 10% note in exchange for Mark Chambers' outstanding AR. Mark Chambers not paying his balloon. We don't want to dart it. We don't want to even deflate it. We want to say, all right, Mark, here's the deal. Let's turn that AR into a notes receivable. You got to be careful on that kind of stuff. Like, you got to make sure you know what accounts are going where. And we're just turning an AR into a notes receivable, $9 grand. The other players, the percentage and the time will factor in later. December 31st, the accrued interest on the chamber note. Is he done paying yet? No, it's a 12-month note. We're not going to see it until the next year. But we've earned some interest. How much interest? Okay, let's take a peek. $9,000 note, 10% interest. How many months have we had it? Have we had it all of May? Yes. So you basically got to count up from May, June, July, August, September, all the way through December. How many notes or how many months have gone by on this note? 8. Interest receivable goes up. We also have earned revenue. We've got some 2014 revenue that's earned. It hasn't, we've earned it, or it has accrued, we just haven't actually seen it yet. But we still have to count that as 2014 revenue, even though we're not going to get the money until 2015. That's why the receivable goes down later. Why is it 8 months? Because all of May, June, July, August, September, October, November, December. 1, 2, 3, 4, 5, 6, 7, 8 months have passed. You got to be careful on that, the dates. Okay, May 1st, all of May was used. Da, 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 da. On December 31st, we closed the interest revenue account. In my notes, I said we're omitting that. We're not going to worry about closing entries right here. I don't want to. They're not having us do all of them, so I'm not going to do just one. Okay, I'm omitting that. What happened then in 2015 on May 1st on a 12-month note? He paid his bill on the maturity date. Received principal plus interest on the chamber note. No interest has been accrued in 2015. So, oh yeah, it's way down here. I gotta scroll just a sec. We made $900 on this fella because we had cash come in at $9,900 on a 9% note. 10%, excuse me, I keep getting my percentages wrong today. Principal times rate times, what number are we plugging in? On a 12-month note, we've already accounted for 8 of it. January, February, March, April. Wait a minute, I thought it was May 1st. Are we using all of May? No, it's just getting us to May 1st. All of January, all of February, all of March, and all of April. Okay, why? Finally, I like it that they did it this way. Thank you. I'm going to stop right there. Cash came in at $9,900. Notes receivable went down because that was the original principal. So glad they did it in this order. I like this order better. The debits and credits do not equal. Have we already said that we earned $600? We did. Oh, sorry, that was the before one. Yeah. Have we said we already received or earned that? Yes. So you are going to see that interest receivable go down. It's basically just, it's not that we're not getting the money, it's just that, think of it like a balloon. They're paying their bill. It happened, but now they're going to pay their bill. Think of it like a receivable that owes money to us, because that technically is. But we've also earned more interest revenue in 2015. We can't say that we earned another $600. That would be unethical. Cool, let's try 12. Do you want to try 12 just to gain a little bit of confidence in this? And then I'll show you the answers. It looks like we're extending a note in a settlement of an AR. We're loaning some cash to someone. We've accrued some interest. We've paid, yeah, you guys can do it. I know you can. We see a split though between years. We see 2014 and 2015. So just take some time. If you get hung up on one, just stop and then I'll help you. I'll hit pause on the recording again. Let's take a peek at this exercise. I don't have the book in front of me, but I'll just run with it. It looks like we turned an AR into a notes receivable, a Goodwin AR to be specific, of 30 grand. The next one, it looks like we did a notes receivable. Well, we gave them straight cash of 25 grand. So holy cow, talk about not balloons, but blimps as far as floating money out there. And we stopped and said, how much money have we earned just on, it looks like the Goodwin account, being that's a 30 grand. So, oh, we had to do them both. Okay, that makes more sense. So if you combined them, if you lumped them all together, that works too. Either way. So we take the 30 grand times 12%, 9 of 12 months. Notice it's not divisible by 360, which means it was a 12-month note. So we used it all of April because I see April 1st, May, June, July, all the way through December. So we had that one 9 of 12 months. The second one we had 6 of 12 months. Again, if they're separated, that's fine, or if you've lumped them together, that's fine. We have earned the 27 and the 1250. It's a receivable. It's just like a balloon. It's floating out there. We have not gotten the money, but they happened. If we would try to claim that money next year as revenue, that would be unethical. We claim it this year, not next year, yes. Because look what day it happened on. So we used it all of July, August, September, October, November, December. Yes. Yep. Anytime it says month, it's divisible by 12. Anytime it's days, it's divisible by 360. Yep. Good question. Then the next year, we're already flipped over to the 15th, year 15. This must be the Goodwin note. Again, I like that they list notes receivable first because you can tell we've got $33,600 coming to us in cash. Notes receivable went down. if I had to stop there, the note goes down, the cash goes up. Why is there such a larger amount of cash? Because we have earned interest. Now we've already earned some of the interest, and you actually see that receivable go down because we can't say that we've earned that again in 2015. We earned that in the 9 months that note existed in 2014. We can't say we've earned it again. That's why you see that receivable go down and you see interest revenue go up for the January, February, March that we've had it. There's two ways to check that number. You can go back up and say, okay, before we had 9, now if we add 3 more, that equals 12. Or you can also look at the date and say we had it all of January, all of February, all of March, because April starts that next month. And the same thing goes down here. We see a $25,000 note receivable blimp, done, gone. We earned money off of it, but we'd not totally. We earned some in 2014, which went down. Going back to what Ashley asked, it's a 9-month note. It sure is. We used 6 months in 2014, 3 months in 2015. And again, it happened on 4/1, so I can see that another way to check it is I used it all of January, all of February, all of March, because we didn't really, we used 1 day in April, but not the whole month. Had this been days, it would all been divisible by 360, and then the very specific stuff matters. Not the day we issued the note, but up to its maturity date, yes. Tomorrow we'll do a self-test just to get you thinking about all the vocabulary for the chapter, and we'll get into problem A. Tomorrow night you will have homework, the B-set versions of everything.